Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, February 2nd, 2023. It is 10:58 a.m. Eastern Time. I'm starting the video, so we're about an hour and a half into the trading day, and I wanted to do an update on the markets, market-leading FAANG stocks, and just reiterate that tonight after the close is the biggest, probably the biggest event of the year so far, bar none, and that is the trio of earnings between the three of the largest components of the stock market, of the NASDAQ 100, of the S&P 500. That's Apple, Amazon, and Alphabet, Google's parent company, all reporting after the close. As I said yesterday, I believe that they collectively will have they have the potential to have a bigger impact on the market than the Fed meeting. The Fed meeting was, I'll talk on that in a second. Well, let me talk on that real quick, and I'm going to show you the 1-minute charts. So the Fed meeting, by all accounts, this was pre-Fed right here. This I just jumped to a 1-minute chart and just show you what happened. You had a 2 p.m. Here it is, 2 p.m. right there. There's a Fed meeting. So you had an initial move down of about almost 1%, then a move up of about 1%, then a move down of about 1.25, a little over 1, and then, as I always say, the initial reaction, which was this, sharp move down at first. Doesn't look like much here when you see the previous move, followed by another reaction, which again was faded, and then that reaction faded. And that is, again, typical. And like I said, you know, that's the only way to trade it, other than have, know that you're going to have the back and forth, and you can set buy and sell orders if you can guess the initial direction in reverse. But it's the algos, fast trading. And then, so here's what happened. Here's my interpretation of what happened. I turned on TV to just listen to the decision, and of course what Powell said. And I watched, Powell's press conferences here. And even as he was talking, it was going down. So what came out is by every account, and I even listened to the talking heads afterwards, kind of give their take on it. By just about every account, he came out more hawkish than the market expected, which should have been a negative reaction. However, it was the opposite. I watched right as Powell, you could tell, it was wrapping up his comments. Even before the speech ended, this started happening. And what that is that's institutional buying. They were firing off buy orders. It's appeared that they were waiting to hit the buy trigger until they knew he was finished talking, so there are no more bombs to drop. But make no mistake about it, it came across more hawkish than expected. Expecting another hike in March, and he spoke the hawkish talk, but yet the market didn't. It went up, and that's an important thing. Now, I always say this, and this is important. One day doesn't make a trend. Even 2 days doesn't make a trend. And so just keep that in mind. But I told you guys I would tell you what I plan to do heading into the big three tonight, the big earnings. And I'm going to talk on that as far as, positioning and what to do. Like I said, it's kind of a blackout period, trading around the Fed. And the Fed, not just the Fed meeting. The Fed, as I said, to me was a smaller event. Although he did come out a little hawkish, more hawkish than the market expected. Now, don't get me wrong, we still got our quarter-point rate hike. And the one thing about the Fed is what they say today is not necessarily and usually isn't what they're going to do down the road. The Fed will, come March, we'll see what happens. I wouldn't hold my breath to, try to figure out what the Fed's going to do a month or two from now. But with that being said, the big thing is tonight when the big three report. And then let me show you the technicals. So that's what happens. We rallied, closed the day. They built on that rally today. As I said, I expect by the end of the day, we'll see some profit taken. And you know what? I'm going to even show you some levels. Let me just dive into the chart. So QQQ. I have this back from here. I want to tell you what's similar and what's different from before. I know this is a busy chart, but this is the original one. I've had all the lines. This was, back here, going long, bullish into the run up. Off that, the Christmas trading range, and then the rally there. I listed this red box as what I still, then and still consider the most likely bounce target zone, where we go off this divergent low, positive divergence breakout there. And remember, if you recall, we hit in pre-market, not shown here, we had a perfect tag of the 200-day moving averages that came in together, the red and the blue line and the downtrend line, and that was a excellent shorting up, took us down to those lows. I'm sorry, that was a Christmas trading range. My bad. That was the October low back there. That sent us down, and then this is it. Now, what is different this time around? And I told you I would let you know my thoughts. I am not as keen at this point in time on adding or even taking any shorts into the close. I would rather wait and see what the big three do. Why? Because that time around, that pre-market rally into the middle of the bounce target zone coincided with triple resistance at minimum. There may have been some Fibonacci retracements in there, but you had the downtrend line, the primary benefit of the downtrend line in the 200 days. This time we took out the 200 days, and as I said, in fact, we put in lower lows. It was a little atypical. We got the rejection there, and then we rallied up. We tested the 200 days and the downtrend line for a while. Took it out yesterday after the Fed. So this is the market saying, even though the Fed came out more hawkish than the market expected, it still bought it up. This is a market that wants to go up. That's all I can say. Now, this can be faded. One day doesn't make a trend, and this is day two, so I consider this really a two-day event. The Fed was yesterday at 2 p.m., and all this happened at 2:30, after 2:30, after Powell spoke, wrapped up, and then today so far. So this is just really, because there's such big events, and again, I put a bigger weighting on the FAAMG reports tonight, that it's really a single event. And that makes me think to back here. This is not, to me, a go long. The risk reward now, I'm going to show you the charts, is every bit as unfavorable to taking new longs as it was back here when we were at the 200 days. And please don't mistake, if I say the risk reward on something isn't favorable, let's say to go long or to go short, don't confuse that with it saying that it's going to go down. If something doesn't have a good risk reward to go long, that just means I don't take it. It doesn't necessarily mean I think it's going to go down or it must go down. In other words, it's not binary. It's not one or the other. I'll show you why the risk reward's not attractive in a second here from a technical perspective. Despite the recent breakout, that's what I want to talk about. So, remember yesterday I did a bunch of bullish and bearish check marks, and so far this is nothing but bullish. But again, what happens on a Fed day and before these FAAMG earnings, I put a next to a zero weighting on it. Why? Well, let me show you something back here. Do you remember this candlestick? This is the major low right here. This is the most of 2022. This, bar none, to me, is the most significant single-day technical event. What that was, we had undercut the lows, the previous lows. I think was it the S&P? We had another. Yeah, we did. We had these lows right here. We were testing this low. See that? That is a massive bullish engulfing candle. And what happened? It was a Fed day, and we went down. And looked like we broke the lows. It looked like that was it. And by every, the selling was impulsive. And then they turned around and they bought it up. And they ended up printing a bullish engulfing candle, which is a huge, one of my favorite reversal sticks. Talked about at the time. That's a bottoming stick. So that was very bullish. But the takeaway was, it happened initially. The reaction and the technicals were very bearish. Almost this. In other words, this taking out of the 200s and the downtrend line has a potential, again, only the potential, it would have to fail, to be this in reverse. And again, that was an undercut of the previous lows right there. And big support we had, that was actually the support line right there. It comes all the way back from back here. We had nice reaction low there, and took us to a new bear market low, but then reversed it. So again, wait and see is to me the safest bet. Now let me show you the technicals as to why, although I will give a 110% check marks yesterday and today so far to the bulls, I think this will get faded before the close today. I'll show you why. But until and unless this breakout fails, by fail, it has to come back down. We have to go back, and that to me is a heavy, not the initial pop. We could come and test the 200s, but anything much more than just a brief undercut cut is going to be very bearish, because now we've taken out the 200 days, we've taken out the trend lines, and by all accounts, from a technical perspective, at best a back test and then a rally here. Anything less is a failure, and look, we're still in, by many metrics, a bear market. We have a long way to go before we take out this major reaction high. I will give the NASDAQ 100 points. You have to recognize it. So far you have a series of 3 distinct lower highs there, and then 1, 2, 3, 4, now 5 higher highs. That is a uptrend, but this is a intermediate term uptrend within a longer term downtrend. But again, tremendous amount of bullish check marks lately. That you can't take from it, the downtrend lines in the 200. So now let me show you some levels, and I will wrap this up, and we'll see what happens tonight. All right, let me go to my clean board here, which I've been using lately. And this just to kind of recap, especially for those of you new or just catching up. There was the primary, what I call BOD, or benefit of the doubt trend line, clearly taken out now. That's not like we're on it. No, we're clear, and we're also clearly put the 200 days in the rearview mirror. We are at the top of my most likely bounce target zone. But what's different now than then? Last time we were in the middle, and I highlighted that as an objective short entry. We were at the trend line and the 200 days. Now they're clearly behind. Remember, I laid this bounce target zone out back here when we were coming off this low. Now it's a little different because of this. So I am no longer interested in, heavy shorting or being short at the top. I'll wait and see what the FAAMGs do. Let me show you some other levels here to watch. Let's see what I have on SPY. SPY's clearly also taken out back test, broke out back test. The SPY had a very distinct single downtrend line, no BOD. It was a lot of reactions. 200 days, nothing. Again, nothing right now but bullish price action. And so until and unless all this fails and we take out this trend line, there is no way that I can spin, or I think anybody can spin this recent. Especially, you can see now, remember, this was our previous highs right there. Now we have a new high. So as long as even we could fall back below that high, ideally, and again, these I talk about these uptrend lines, the definition, higher highs, higher lows. You can look at each distinct low. For example, if we take out this previous high, that's going to be a new high in SPY. But the bear market, until you take out that high, it may not. You can't say it's over. We could run all the way up there and turn down, and then go on and take out that low. So remember, bigger picture stuff. And I always, all along, from before this thing started, said this bear market's going to play out a lot different from others. It started out with so many similarities to the previous bear markets, but because of the macros and the technicals, and the fundamentals going on in the economy right now, both the U.S. and world economy, as well as the technicals, I think this bear market's going to play out a lot different, a lot longer, a lot slower, versus those that have averaged about a year and a half or so, 15, 18 months for the last 30, 40 years. All right, so that's it. So I'm in wait and see mode, and let me show you what the big FAAMGs are doing. This is the most important thing to me right now. Oh, well, let me start, because I keep forgetting. I posted the VIX yesterday. Show you the VIX is now, let's see where we close the day. The day's not over. We're just below the trend line, but again, day's not over. I would put very high odds of a fade, a profit taking into the close, and I'll show you why. Not just a hunch, not just because we're up a lot in the last couple days. I'm going to show you in a second. So the VIX will probably close back up or on this trend line and within this. Still very much, even if it took out the trend line, you have price support below, and you still have strong positive divergences that say a reversal is likely. In this whole scenario, if the market does not like what the FAAMGs are selling, the VIX could explode out of this bullish falling wedge pattern. That's the purple lines that I have here. Now I'm drawing over them in blue. So you can see there's plenty of room for a little bit lower and still keep those divergences intact. And now let me go to the FAAMGs, and I'll wrap this video up, get it out to you guys. Apple. Okay, Apple, back here, one of my top picks, coming off the lows, and it's, rallied, but look where Apple is. Let me turn off I'll leave these lines on, then I'll turn them off to give you a clean board. This whole area here was big, it was a lot of resistance there. We popped it once, resistance, pulled back, support, broke it there, gave up the ghost, tried to back test it, tried to regain it, back tested, rejected. got above it. So Apple, I will say, has been choppy. It's kind of chopped through the 200s, chopped through that level, but I still think that's a fairly significant resistance zone. And when you turn off all the lines, look at that, in very, very close proximity to the 200 days, which once we started really getting some downside traction on Apple, these 200 days have capped the advance. And historically, if you look back decades, the 200 days, the simple and/or exponential moving average does a great job at defining bull and bear trends when you're above and below it. Apple's kind of been more of a slow roll. It's been the strongest of the FAAMGs this time around, but you can see when you go to a weekly chart, you can see these same 200s defining the trends. And you know, when you take it out, you're in correction mode. And you took them out there, you had a 25% drop, and then you took them back. And so we're still, for all intents and purposes, below them. Looks like we're trying to regain. This is a weekly chart, so, and that's a good thing to look at too. You know, the daily is going to give you more whipsaws, and with the FAAMGs reporting tonight, we're going to see how Apple closes tomorrow. So Apple's either going to clearly put these 200 days, which on a weekly time frame, which I'm on now, you just use a 40 week. It's the same thing, 5 days in a week. 5 times 40 equals 200, so that's why the 40 week on a weekly chart's the same as the 200 days. Great. You know, in a bull market, you buy pullbacks to that level. Once it breaks, you buy pullbacks. Once it breaks, you're short. That was a whipsaw. Nothing's perfect, but it's been rejected since. So if Apple, the market likes what they're selling tonight, then it takes those 200s back. Maybe it'll prove to be a whipsaw, or maybe it'll be a trend change with more upside in Apple. We'll see where we go. I am leaning towards a rejection still, despite the recent bullish action over the last few days. But we'll see. It's not. It's just the odds aren't good enough to bet it right now for all the reasons I started out in the video. Let me show you Microsoft. Turn on all the lines here. This is the primary downtrend line. Let me show it to you on a clean board. There it is. Let's take away this. So this is my BOD, or benefit of the doubt, primary trend line. This is the all-time high in Microsoft, your bull market high back in November of 2021, when a lot of the NASDAQ stocks and the NASDAQ itself technically topped. And you have nice, clean reactions on there, with several starting out here when we top, 1, 2, 3, close there, perfect reaction there. Perfect. Well, that was the other trend line below. And so you're at trend line resistance, and just a 1 day pop. You are above the 200s, I'll give it that. And again, how we close tomorrow, if and in the next week. Remember, tomorrow they report tonight, so the first full day of trading when the institutions are really on the field, you know, during the regular session, that's Friday. Don't put too much into what happens in the after hours. If you did that last time, or if you recall, Microsoft in after hours rallied up and hit the 200-day back here. They reported, I think it was this candle, rallied, pegged the 200 and got rejected hard. It rallied in after hours right into the 200 and then came down. So again, wait until the dust settles, but I just wanted to point out this is one of the top components of the NASDAQ 100 and S&P 500 above the 200s. So as long as that holds, great, but it's within spitting distance, meaning one day, one bad day, it could be back down above, or one good day, it could put that farther in the rearview mirror, and that's how it works for me. It's just like if you've ever bet, you know, gone to the horse races, and you're looking at the board, the odds are changing minute by minute up until the betting is closed, and that's because they have money coming in, and they're trying to balance that. If everybody's betting on one horse here, so you get tip on a long shot, and all of a sudden the odds are so much money going in, the odds are going to change, and then once the betting closes, the odds are fixed. So where I'm going, it's the stock market's the same way. If tomorrow, Friday, and the next week, the farther Microsoft gets away from these 200s in the downtrend line, the more likely that breakout is to stick. And at best, you get very overbought and you come in and back test, and there's your objective entry. I wouldn't buy this, but I would buy this if that happens. However, if we fail, then that's going to be very bearish, a rejection. Now that we've taken them out, and if we get rejected off that trend line, and you still have uptrend lines you can look at. So there's Microsoft. Bottom line is, this is one at resistance. Apple, I already showed you, really close to the 200 days, close enough to resistance to not say that the markets have broken out yet, the FAAMGs, despite where we are in QQQ. Again, I always say this. You want to know where QQQ is going, you only have to know where the FAANGs are. Apple, Microsoft, Amazon, Alphabet, and now Tesla, because it's gotten so large. Amazon, this was my favorite pick back here, bullish falling wedge. And I believe I stated back in the beginning of the year, beginning of this month, I could see a run maybe all the way up here to test the 200s because it hadn't. That's exactly where it is. So I can tell you right now, not only is the risk reward not good for going long at this point right now, that can change tomorrow, can change next week. It is actually starting to look really good again for shorting, but again, why gamble? Let's see where these guys go tomorrow. All I can tell you is this is an extended overbought rally in a bear market. You were overbought. The last time you were overbought in a bear market was right here. This is what, and you were right at the 200 days right there. You were at the 200-day simple, and here we are again. This is an exact technical posture. You were overbought. You had a comparable run that felt nothing like bullish, and it is bullish if you were in it, but at that point, this is when you wanted to buy. This breakout. I highlighted out Amazon as a buy here. I highlighted as a buy here as my favorite at the time. Here and here. We got that. I mentioned selling it there on that first pop up because there was a target hit, and then rebuy there. That's when you want to buy Amazon. This is when you want to sell Amazon. So take that for what it's worth, guys. There's a potential trend line if it blows through the 200, so I'm going to turn it up a little so you can see. I call it potential only because there's only 2 reactions. I like to see 3 to validate it. So if it does pop up and then fails it, that's something to watch. So that was the bullish case. This was the time to get long, and now this is a time to take profits if you haven't already, and or go ahead and short it. I can tell you all day long it's very objective to short in a bull market with overbought readings and at resistance. So that's stock number 3, at or very close to major resistance, market leaders. Alphabet, I have 2 share classes. Let me look at GOGL. I usually mark this chart up. Let's see what I have here. Okay, I'll use that board I was on. Lot going on here. Okay, first of all, we have the 200 days, the big 200 days right there, intersecting together both the exponential, the red one, and the simple, the blue one. Exponential did the trick perfectly right there, rally into it. Remember, we kind of went in a trading range, chopped through them a bit, gave up the 200s back here. That's when we broke it, went down, set up in this trading range. That last final pop to the top of the trading range was a rejection off this downtrend line right here and the 200. We went on to pop this downtrend line today. That was that yesterday, yeah, today. And now that's taken us within, again, very close proximity to the 200s. Rarely are you going to, it's like Monopoly, well, not like Monopoly where you get the jail card, go to jail. It says pass go, don't collect 200. Rarely you just come up and then blow past the 200s and keep going. At most you come in, you check them and consolidate on them for a while. So bottom line is we're at very good resistance on this one as well, and this is one of the market leaders. There's a potential downtrend line with 1, 2, and if we get rejected here, 3 reactions, although we haven't yet. And then the trend lines again. We'll see how we close the day. If they do dump this, take some profits into the close, as I suspect, we're going to close right around on those. And then you have gap support down below. So I had a different board here too. Oh yeah, what I wanted to show you, let me go back to this one. You also have this big old trading range. That was major support, about 105 right here. It was a well-defined trading range. I would talk about these all the time. You ping pong in them, buy the bottom, sell the top, and then whichever way you break determines the next trend. Usually you broke to the downside, you went back tested it, rejected, and this is now again we're a hair above it now. If they can put it, the farther we can get back into this range, the more likely that's going to stick, and we're going to see more upside in the coming weeks to months in these market leaders and in the stock market. If we get rejected here, and that's just a one-day whipsaw, then that's going to be yet another rejection there, and you could risk, you would fall back below the 200-day moving averages because they come in perfectly with that. I have it at 104.79. Again, I'm rounding up to 105, so you have a major resistance there. And yes, as of this point in time, we gapped up. We're up 6.5% above it. If it holds, great. If it doesn't hold, well, that's a failed breakout. And a couple more. Tesla's next. Okay, so Tesla. If you go back to the January 4th video, this was one of my favorite stocks. Took long, threw it out as a trade idea within the wedge. And if you watch that video, trade ideas, I said, if the market can get some traction, Tesla's, has the potential to run all the way to here, right here, to that two. That's the level. Was it this one or that one? I think it was that one. It was 50%. I remember calling it about a 50%. Oh, it was this one here, and we've already taken that out. So this is another line I had. This is the next resistance level. That's actually where I was calling for, and it would already exceeded that 167.50 something. Yeah, that was the 55%, 50+% return. But let me turn on this level. That is big resistance as well. Let me just turn the numbers on. 199.73. Let's make that an even 200 because everybody likes round numbers. So $200. That's 2,000. $200 price resistance, very, very well defined. Go to the daily chart, and there it is. I already had on my daily. I had it at 202 and a quarter. Big level. Major reaction low, reaction low, reaction low, reaction low, and then boom, support. Once broken, becomes resistance. I would be not shocked, but surprised to see Tesla go through that 200-ish, 202 level, and these 200 days, which it got rejected on before back here, like it wasn't even there. So, yeah, the risk reward again is certainly not favorable for buying Tesla here. If you didn't buy it there, this is where you want to, sell or look to get short for a pullback. If you are a bull and you think Tesla's going to take it out and you get rejected there, well, here's a trend line. You can buy a pullback to that trend line. But coming up on major resistance. And then last but not least, NVDA is starting to carry a pretty good weighting in the NASDAQ 100 because it's just eating Intel's lunch. And there's a 208 and a quarter price resistance. Although, it's taken out the 200s and taken out the downtrend line. So again, this is nothing but bullish on face value. However, it's getting, like everything else, very overbought, and the more objective entry would be on a pullback, especially a back test of the trend line or the 200-day moving averages. As of now, it's just not objective to go long. And again, as I said in the beginning of the video, to say the risk reward is not favorable for going long something or going short something doesn't mean it has to go the other way. It has to go down. It just says, your upside is limited compared to your downside potential should we get a sudden reversal there. And when you get again overbought in a bear market, only time will tell. Only time will tell if the bear market is over. And if it is over, then what I showed you yesterday in the video, overbought tends to stay overbought for an extended period of time with multiple readings on or around the overbought level, or become more overbought. But in a bear market, it's usually fleeting, and you go back down after becoming overbought. Usually your next stop is oversold with another leg down in the bear market. So this was the end of the bull market. There's an example of overbought staying persistently overbought and going extreme overbought readings, persistent overbought readings, the end of the bull market there. And this is bear market action. Spending most of the RSI spends most of the time down below the 50 level. The midpoint on there, and frequently becomes oversold. So all right, guys, interesting times. I'll let you figure out how you want to be positioned, if at all. I love taking trades, but I think I'm going to sit back now and watch to see how these FAAMGs report. I got other trade ideas out to you. Remember, the markets are only one thing. You don't always have to have a position long or short. GDX, liking the action on that so far. Broke down from that bearish rising wedge the other day, popped up, and I'll talk on that real quickly too. The euro, the dollar. So the Fed yesterday was more hawkish than expected by every metric, everybody I listened to, and from what I heard. And so that should be bullish for the dollar, right? Makes the dollar go up. The ECB was also very hawkish now, and so there's cross currents there. The ECB, well, the ECB gave us the 50 basis points that they were going to, but they also said they're going to keep rates high. So the markets, the forex markets here, I want to show you. That's what I want to get to. Trying to parse through what's going to happen. You can see the initial reaction there, and then a fade so far, and so you still have the same technical posture in the euro, and for that gold trade to get some traction, and I think it'll happen. You can see big negative divergence here, just like we had big positive divergence right here. That was a divergent low that gave us this whole thing right here from a technical perspective, and now this wedge still looks, I've been favoring, we just have to get the breakdown. The breakdown is going to consist of a move down below the wedge here, the uptrend line right there, and so far as you can see that's why you don't take the initial reaction. The euro popped, the dollar going down, and now it's being faded. So once this happens, then gold and the mining stocks and silver will be an all-in short, especially this if you want to play it safe, 107.633 on the euro US dollar. But the gold itself breaking down today. I told you before, we had GC whipsaw the other day. That's right here. GC, this is the 60-minute chart of gold futures. There's our primary uptrend line. This was a pre-Fed and pre-ECB and BOE. All the central banks raised rates yesterday and today. That was just like taking Apple and Amazon and Alphabet before. It would be just like taking them today. You take them before earnings, it's a crapshoot. It can any breakout or this upside breakout in those big three tech stocks could fail depending on what happens tonight. And so that's what happened. We had a breakdown in gold, pushed up, and all we did is simply got back above the trend line but made a new marginal, even bigger divergent high, and now we've broken down. So what I've done, the only thing different since the chart I got out to you, the same chart this morning, I added a price support level here at 1933.50 that I noticed right after I got that out to you. We've been dancing on that level recently other than this one whipsaw. So I think the next break of that should open the door for those targets I gave you in gold, something like that. And like I said, we finally have it. A lot of traders, even hedge funds, I know this to be true, buy this, the ETF. They'll use sometimes futures, but a lot of them buy GLD. It's been around forever. It's liquid, does a great job of tracking the price of gold. And you have as I pointed out recently, the bearish crossover on the PPO recently, negative divergence on the RSI right there. And now if this holds, you can see the red candle. We finally, for the first time, well, no, we've been below the trend line by a hair recently, but we haven't closed below it yet. Again, this is our primary bull market trend line off the November lows with that big fake down move. The fake down, false breakdown below 158 followed by the recovery. That's a very well-defined trend line. And then I'm going to take this line right now and I'm going to match up what I just gave you on GC, pretty much what we're testing now, and you can see why I did that. That's the same. We have 1, 2 candles from below there, 3, 4, 5, 6, 7, 8, 9, 10, 11, and now 12. Very well watched level. If we take it out, and which I suspect based on the technicals, that's going to be very bearish for gold. Probably a quick swoon down. Silver should fall even harder, and so it usually follows gold, but more so. And then again, GDX is straightforward. It's showing you, the breakdown already occurred. If you missed the breakdown, you had an opportunity to back test. Remember, that might be confusing to some, but this is also at one point, it's also a long-term trade idea. These were the targets on a trend trade. I'm only looking for a correction in an ongoing bull market in gold, and these are my targets, T1 and T2, and then another swing up. So these are the long side targets. That's why I listed it T1S, meaning short, T2S. These are short pullback trades, counter trend trades in a larger trend, if that makes sense. And again, the odds of these playing out will increase drastically if gold takes out today's lows, those support levels we're dancing at right now, and prints a solid close below the uptrend lines that I just showed you. All right, guys, I will wrap it up here, get the video out to you, and probably not even comment on whatever the big three do today after the close, because that really doesn't matter. It's how they trade tomorrow into the close tomorrow. and maybe even early next week if we don't have any definitive, if they just kind of park themselves right on the 200 days and the trend lines, it's going to kind of still be a guessing game into next week. So, but I will most certainly, if not later today, do an update tomorrow on how things look for the markets. This has been Randy Finney with Right Side of the Chart. Have a great day.